Well, loan growth has been a disappointing one. YOY, it's perhaps the lowest growth that you are seeing in the last 4 quarters. Sequentially, it's one of the weakest growth in 6 quarters. Now, real estate is witnessing a bit of slowdown due to higher interest rate. We have seen that with other players as well. What is your outlook on real estate sector and housing finance sector in a rising interest rate scenario, sir?
I think very clearly the slowdown that you are talking about is in the non-individual category. If you look at our loan book growth, our individual loan book growth was 18%. And historically, if you look at the last 6 or 8 quarters, this is the second largest growth rate we ever had. September was the highest growth rate, which was 20%, and this time it is 18.4% or so. Now, part of the reason is that period, April, May, June, was in the previous year, was a period which was affected by the second wave of COVID. And therefore, when we were comparing the first and second quarter with last year, we were comparing it with a very weak previous year because of the COVID impact. That gets neutralized over a period of time. So third quarter is actual growth, what we are seeing, and the growth is healthy. It continues to be healthy at about 18.3, 18.4%. What you are referring to my mind, is the overall loan book growth, which is arising out of the reduction in the non-individual loans. Now, non-individual loans have shown a decline. There are 2 reasons for that. One reason is that construction finance loans, where there is a reasonably good pipeline, construction finance loans do not get dispersed the moment they are approved. Unlike, let's say, a corporate loan or a lease rental discounting loan. A construction finance loan is linked to the stage of construction. So as the developer constructs, as he builds, he needs money and we disperse money. So it's linked to construction. And construction takes a 4 to 5 year time frame before it gets completed. Now, the period from 2017 to 20 was a period of slow growth in the real estate sector. And loans given and projects launched at that time would be typically projects for which you'd be dispersing today.
Okay. What is the pipeline you have in terms of construction finance, sir?
Pipeline is good because a number of new projects have got launched in 2021 and in 2022, and the pipeline therefore looks strong. But as I said earlier, these loans will not get dispersed right away. They will only get dispersed as the construction takes place and the builder needs money. And these are dispersed in not one, but in several installments. So but by the time it reflects in the loan book, it will still take a couple of quarters.
How do you see prices in the real estate sector in 2023?
So we've seen property prices go up a little bit. I would say, if you ask me, an average about 6 to 7% is the increase in property prices on a pan-India basis. But there will be centers, there are cities, there are locations where the price rise is higher. So I think Delhi is a little higher, Mumbai is a little higher, but generally on a pan-India basis, about 6 to 8% is the increase we've seen in property prices in the last 1 year.
Well, in a rising interest rate scenario, we have seen yields of all the NBFCs, banks, etc. Going on really well, and that is aiding the net interest margin and spreads as well. Going ahead, incrementally, your cost of funds may rise given the fact that we are in a rising interest rate scenario. So what is the outlook on net interest margin and spreads going ahead?
Our net interest margin over the last 10 years or more, quarter after quarter, have always been in a range of 3.3 to 3.5. For the period ended September, both for the quarter ended September, as well as for the 9-month period ended September, our net interest margin was at the higher end of that range, which is 3.5%. Interest rates go up. Immediately after, when interest rates go up, the lending rates also go up. So they're completely matched out. But what happens is when we increase the lending rates, particularly to individual customers, our agreement with the customers over the years has been that the rate increase comes once in 3 months. So 3 months from the date you've taken the loan, every 3 months from the date you've taken the loan amount, the interest rate gets repriced. And therefore, any increase or decrease in interest rates comes over a period of 3 months. So this gets neutralized. So as long as rates sort of stabilize, the cost of funding should also stabilize. And the lending rates will actually start going up. So theoretically, if there is no increase in lending rates in this quarter, then lending rates the effect of the higher increase in the rates will get affected in this quarter, whereas costs would remain partly the same. It all depends on whether RBI increases rates or not.
A two-part question on the merger front. The merger timeline, would you be sticking with the June 2023 date that you have given?
All right. So the merger should happen as scheduled. June or July would typically be the time when the merger gets completed in all possible respects. There is the NCLT approval or the NCLT hearing, which is going to take place today, which is 3rd of February. And once the NCLT hearing is completed, then we still have to go through certain processes. We've asked for forbearance from RBI. We still haven't heard from them. But all these things will fall into place over the next 2 or 3 months. So June, July, pretty much on track.
Now, urbanization has been at a rapid pace, and population rising should also aid in growth. Could you give us a highlight in terms of the outlook that you see for loan growth going ahead?
My view is that the loan growth will only accelerate after the merger is completed, further accelerate. So if you look at it, HDFC Bank used to be about 27% of the business we do, typically, prior to the merger getting announced. Now that 27% has become 30%. So already they are sourcing or they are doing more and more of housing loan, or bringing more and more of housing loan customers to our office. And once the merger gets completed and the full integration process gets sort of rolled in, then I would expect the volumes to increase much more.
Well, that's the word coming in from Mr. Keki Mistry of HDFC Limited. Loan growth would continue to outpace, especially after the merger. Thank you for your time, Mr. Keki Mistry.
Thank you. Thank you so much.
Thank you, sir.